Welcome to UK Property Info. Sundar. There is something coming for millions of UK homeowners that most of them have not properly prepared for. If you are one of the estimated 1.6 million households whose fixed rate mortgage is expiring in the next 12 to 18 months, this video could save you from a financial shock that catches you completely off guard. Even if your fix is not expiring soon, you need to understand what is happening, because it will affect the entire property market in ways that touch everyone. If you find this analysis valuable, please take a moment to subscribe to this channel. We are a small, independent voice trying to help ordinary people navigate what has become an extraordinarily complex property market. That simple action helps us reach more people who need this information. Now let me explain exactly what is coming and why so many homeowners are about to be blindsided. The first thing you need to understand is the scale of what is approaching. Between 2021 and 2022, millions of UK homeowners locked into fixed-rate mortgages at historically low interest rates. Many secured deals at 1.5% or even lower. Some paid under 1%. At the time, these seemed like normal market rates. Nobody imagined they were actually the lowest rates in 300 years of British banking history. Those 2 and 3 and 5-year fixes are now expiring in waves. The first wave hit in late 2023 and early 2024. The next wave is building right now and will crash through the remainder of 2024 and into 2025. The numbers are staggering. Approximately 1.6 million fixed-rate mortgages are due to expire within the next 18 months. Each of those households will need to refinance onto new rates that are 3 to 4 percentage points higher than what they currently pay. For most, this will mean monthly payment increases of £300 to £600 or more. Annually, that translates to £4,000 to £7,000 of additional housing costs per household. Multiply that across 1.6 million households, and you begin to grasp the scale of purchasing power that is about to be extracted from the UK economy. The reason so many homeowners will be caught off guard is a dangerous combination of psychological denial and mathematical ignorance. Survey after survey shows that the majority of homeowners approaching their refinance date have not actually calculated what their new payments will be. They have a vague sense that rates are higher now, but they have not sat down with a mortgage calculator and worked out the precise impact on their monthly budget. When they finally do that calculation, often just weeks before their fix expires, the shock can be devastating. I have spoken to homeowners who assumed their payments might rise by £100 or £150 only to discover the actual increase was £450 or more. That is not a rounding error. That is a fundamental life change that requires serious financial adjustment. The psychological denial runs deeper than simple avoidance. Many homeowners have convinced themselves that rates will come down before their fix expires. They have been reading headlines about potential Bank of England rate cuts and have translated that hope into an assumption that their refinance will somehow be painless. This is magical thinking. Even if the Bank of England cuts rates 2 or 3 times before your fix expires, you will still be refinancing onto rates dramatically higher than what you currently pay. A base rate of 4% is not the same as a mortgage rate of 4%. Lenders add their margins. The best mortgage rates available today are still between 4 and 5%. Compare that to the 1 to 2% rates many homeowners currently enjoy, and you understand why the shock will be so severe. The second reason homeowners will be caught off guard is the assumption that their property value provides a safety cushion. Many homeowners bought or remortgaged during the peak of the market in 2021 and early 2022. Since then, property values have fallen in nominal terms and fallen significantly in real terms once you account for inflation. A homeowner who bought at the peak might have seen their property value decline by 10 to 15% in nominal terms. In real terms, accounting for cumulative inflation of around 20%, the decline in purchasing power is even more severe. This matters because your equity position affects your refinancing options. Lenders offer their best rates to borrowers with significant equity. If your loan-to-value ratio has crept up because your property value has fallen, you may not qualify for the headline rates you see advertised. You might find yourself pushed into higher-rate products or facing additional fees and restrictions. Some homeowners who stretch to buy at the peak with small deposits may find themselves approaching or even in negative equity. This does not mean you cannot refinance, but it severely limits your options and can result in paying rates well above market averages. The third element catching homeowners off guard is the broader squeeze on household finances that has occurred since they took out their current mortgage. When you secured that 1.5% fix in 2021, your household budget was based on 2021 prices. Since then, energy costs have doubled or more. Food prices have risen by over 25%. Council tax has increased. Insurance premiums have spiked. Childcare costs have climbed. Almost every element of household expenditure has inflated significantly. The budget that once comfortably accommodated your mortgage payment has been progressively eroded by 3 years of relentless cost inflation. Now, into that already stretched budget, you need to absorb a mortgage payment increase of £300 to £600 per month. The math simply does not work for many households without significant lifestyle changes. Some will need to cut discretionary spending entirely. Others will need to extend mortgage terms to reduce monthly payments, accepting that they will pay more interest over the life of the loan. Some will be forced to consider selling properties they can no longer afford. There is another element that few homeowners have properly considered. The hidden costs of homeownership have also been rising dramatically, and these increases are not captured in simple mortgage payment calculations. Home insurance premiums have increased by 30 to 50%, in many areas driven by increased flood risk weather events and claims inflation. Buildings insurance that cost £400 2 years ago might now cost £600 or £700. Contents insurance has followed similar trajectories. Maintenance and repair costs have also spiked. Tradespeople charge significantly more than they did 3 years ago. Materials cost more. A boiler replacement that might have cost £2,500 in 2021 now costs £3,500 or more. Roof repairs, window replacements, electrical work, all have become substantially more expensive. If you have been deferring maintenance during the cost of living crisis, those deferred costs will eventually come due. Energy efficiency requirements are also beginning to bite. Rental properties already face minimum EPC rating requirements, and similar requirements for owner-occupied homes may follow. Improving your home energy rating can require significant investment in insulation glazing or heating systems. These are not optional, nice-to-have improvements. They are increasingly mandatory costs of home ownership that must be factored into any honest assessment of housing affordability. The situation is particularly acute for certain categories of homeowner. First-time buyers who stretched to maximum affordability in 2021 and 2022 face the most severe adjustment. They bought at peak prices with minimal equity cushions at the absolute bottom of the interest rate cycle. Every element of their purchase was optimized for conditions that no longer exist. When their fixes expire, they face the full force of the rate adjustment with the least financial flexibility to absorb it. Many also locked into shorter 2-year fixes, meaning their day of reckoning has already arrived or is imminent. Homeowners who used Help to Buy or other government equity loan schemes face additional complexity. Some must now repay equity loans that have grown in line with property values, while simultaneously managing mortgage refinancing onto higher rates. The combination of these obligations can be overwhelming. Older homeowners approaching retirement face different but equally challenging circumstances. Their ability to extend mortgage terms is limited. Their income may be fixed or declining. Some took on mortgages in their 50s assuming they would pay them off before retirement, only to find that the mathematics no longer works at current rate levels. What makes this situation particularly dangerous is that it is unfolding in slow motion across millions of individual households, each facing their own private crisis at different times. There is no single dramatic event that captures public attention, no single day when the shock becomes visible. Instead, there is a rolling wave of financial adjustment rippling through the economy household by household, month by month. Each family experiences their own moment of reckoning when their fix expires and they see their new payment amount for the first time. For some, that moment has already passed. For others, it is weeks away. For still others, it is 12 or 18 months in the future. The distributed nature of the crisis makes it invisible in aggregate statistics, even as it devastates individual family finances. It also means that policymakers and politicians can avoid addressing the issue because there is no single crisis point that demands immediate response. The property market implications of this rolling mortgage shock are significant and not yet fully appreciated. When 1.6 million households experience substantial increases in their housing costs, their behaviour changes in predictable ways. Discretionary spending falls. This affects local businesses, retail, hospitality, and services. Some households will attempt to sell properties they can no longer afford. This adds supply to a market that is already struggling with weak demand. If enough distressed sellers enter the market at similar times, prices will face additional downward pressure. Potential buyers who are currently waiting on the sidelines observe these dynamics and wait longer, hoping for further price falls. Transaction volumes, which are already at historically low levels, remain depressed. The entire property market enters a period of extended paralysis, where sellers cannot achieve the prices they need and buyers cannot afford the prices being asked. This paralysis can persist for years, until either prices fall sufficiently to restore affordability or rates decline enough to make current prices workable. What should homeowners do if they are facing a fixed expiration in the coming months? The first and most important step is to face reality. Calculate exactly what your new mortgage payment will be at current market rates. Do not hope for rate cuts. Do not assume you will somehow qualify for better than market rates. Use realistic assumptions and calculate your new monthly obligation. Then compare that figure to your current household budget and honestly assess whether you can afford it. If the answer is no, you need to begin making changes now while you still have time. Consider whether extending your mortgage term could reduce monthly payments to affordable levels. Yes, you will pay more interest over the life of the loan, but if the alternative is defaulting on your mortgage, paying more interest is clearly preferable. Consider whether there are expenses you can reduce or eliminate to create headroom for higher mortgage costs. Consider whether additional income is available through overtime, additional work, or other household members contributing more. Have these difficult conversations with your family now, not when the new payment is due. If after honest analysis you conclude that you simply cannot afford to remain in your current property, it is better to reach that conclusion early and sell on your own terms than to be forced into a distressed sale later. Selling proactively allows you to time the market, choose your next property carefully, and avoid the credit damage that comes with mortgage arrears or default. For homeowners whose fixes are not expiring immediately, the message is equally important. Do not assume that because your day of reckoning's further away, you are somehow safe. Use the time you have to prepare. Build savings to cushion the impact of higher payments when they come. Pay down other debts to reduce your overall financial obligations. Consider making overpayments on your mortgage now while your rate is low to reduce the balance you will refinance later. Every pound you pay off now is a pound that will not be subject to higher interest rates later. Review your household budget and identify areas where spending can be reduced. The adjustments you make now will be much less painful than emergency cuts made under pressure later. Also consider fixing for longer when you do refinance, even if longer fixes cost slightly more. The certainty of knowing your payments for 5 or 10 years has value in a volatile rate environment. There is a broader point here about how we as a society have come to think about home ownership and debt. For decades, the assumption has been that property prices always rise over the long term, and that mortgage debt is somehow good debt that will always be manageable. The current situation challenges both assumptions. Property prices do not always rise. They can fall in nominal terms and fall dramatically in real terms. Mortgage debt is real debt that must be serviced, regardless of what happens to property values or interest rates. The generation of homeowners who bought in the cheap money era learned to think of mortgage payments as fixed costs like rent that would remain stable over time. They are now learning that mortgage payments are variable costs tied to interest rate movements, and that those movements can be sudden and severe. This is a lesson that previous generations understood, but that had been forgotten during 15 years of ultra-low rates. The coming months and years will be difficult for millions of UK homeowners. There is no point in pretending otherwise. What separates those who navigate this period successfully from those who are overwhelmed by it is preparation, honest assessment, and early action. The homeowners who will struggle most are those who refuse to face reality until it is forced upon them. The homeowners who will cope best are those who calculate their exposure, now make adjustments while they still have time, and enter the refinancing process with realistic expectations and fallback plans. Whatever your situation, I hope this analysis has helped you understand what is coming and why so many people are going to be caught off guard. Knowledge is the first step toward preparation. Share this video with any homeowners you know who might need to hear this message. The more people who understand what is approaching, the fewer will be devastated when it arrives. Thank you for watching UK Property Info.